Good afternoon. My name is Jill Bullock, and I'm the owner of Silver and Secure. I'm a health insurance brokerage agency here in Texas. Joining me today will be Jordan Sibley and Pat Robertson. Jordan's a certified tax preparer, and Pat is a financial advisor. What we're going to go over is understanding the Affordable Care Act, the tax strategies to make it more affordable, and alternatives when it's not. The purpose here is to educate you on how to achieve affordable health insurance in 2026. There's a lot of changes coming our way, and I need to make sure everybody's aware of them. So we'll cover the basics of the Affordable Care Act, otherwise known as the ACA or Obamacare, tax strategies that you can use, very beneficial to you, and those alternatives to the Affordable Care Act. Hopefully, when you walk away after this video, you'll have clear steps on how to lower and reduce financial risk and lower the cost of your premiums. Understanding the ACA. So the Affordable Care Act came into being, was brought into law actually in 2010. It wasn't rolled out to the public until 2014 when the marketplace opened with my goodness, with premium tax credits. That's the word I'm trying to think of. Excuse me, premium tax credits for your plan that you chose for healthcare for the year. Premium tax credits aren't going anywhere. However, they are going to be reduced. During COVID, what happened was the American Rescue Act enhanced those premium tax credits or subsidies to help everybody pay for their premiums for their health plan. Then they were extended again by the Inflation Reduction Act. They were due to expire at the end of 2025. They are supposed to sunset. We're going to go with the assumption that they are at this point, unless Congress extends them. As we all know, as we sit here on October 13th, this is still being fought out among the group. The government has shut down because they can't reach an agreement. So we're still in a holding pattern. But again, for purposes of this video, let's assume that they will not be extended. So your premiums will get more expensive. The other thing that is going to happen is the cliff is coming back, and I will explain that in just a minute. Eligibility for the Affordable Care Act is based on your household income. It's actually based on your modified adjusted gross income, not your adjusted gross income. Modified adjusted gross income, the only difference between that and your adjusted gross income is a couple little things that are added in. So if you happen to have non-taxable Social Security benefits, those need to be added. Tax exempt interest, let's say from municipal bonds, things like that, that needs to be added into your income. Foreign earned income that is generally excluded from taxes needs to be included to come up with your modified adjusted gross income. What's so great about the Affordable Care Act? The marketplace. Well, it came into being because people that had cancer in the past, had some sort of pre-existing condition, could not get health insurance. This was not good for those people. They, through no fault of their own, they had a condition that they were not able to get health insurance. The Affordable Care Act made this possible. It also made it so that the lower income earners were able to afford insurance. Hence the subsidy, the premium tax credit that people get. There's also the 10 essential benefits. These were defined so that every possible plan that was out there had a uniformity. So those 10 essential benefits are outpatient care, hospitalization, emergency room, maternity, mental health, prescriptions, rehab, labs, preventative care, pediatrics, adding dental and vision in there as well. So every possible plan that you see on the marketplace will have the 10 essential benefits. So moving on, we are going to look at a few things with a maximum out of pocket. all health plans have a maximum out of pocket. This coming year, we are taking a major bump, meaning increase in the maximum out of pocket. For the individual, it's going to be $10,600. For the family, meaning 2 or more people in the same household, your maximum out of pocket is going to be $21,200. I don't know that many people that have that amount of money sitting around. So there are strategies that we'll discuss a little bit to make sure that you have something. If this were to happen to you, you have something in place that can help you. Typically, your maximum out of pocket, otherwise known as your MOOP, will only be met in a catastrophic year. The worst of the worst of the worst has happened to you, and you've paid and you've paid and you've paid, you hit your maximum out of pocket, and then the insurance carrier is going to pay the rest for the remaining part of the year. This resets every year. Then we have our high deductible health plans. Those are changing too. Those are going to go up to $8,500 for self-only, $17,000 for the family. Same thing, max out of pocket is your worst case scenario. We're going to discuss the high deductible health plan in just a moment and why those are changing. But in the meantime, let's compare these. So your MOOP for an individual, just on your regular plan, is going to be $10,600. For a high deductible health plan, it's going to be $8,500. For the family, $21,200. For the family on the high deductible, it's going to be $17,000. So you can imagine if you know you're walking into a year, 2026, and you know you're going to hit your maximum out of pocket. Maybe you were just recently diagnosed with cancer and you started chemo, and that's going to roll into next year. You're likely going to hit your max out of pocket. You'd be better off going with a high deductible health plan because your maximum out of pocket is actually going to be lower. Then we're going to move on to why these high deductible health plans are changing for 2026. So every bronze and catastrophic plan will be considered a high deductible health plan for HSA eligible contributions. In the past, you kind of had to hunt and peck through the marketplace trying to find those high deductible health plans that were HSA eligible. Now it's going to be we have expanded bronzes here in Texas. We have bronze plans and we have catastrophic plans. In Texas, catastrophic plans are almost at the same price as a bronze, so most people will just stick with the bronze. You've got automatic qualification. If you have a bronze, expanded bronze, or catastrophic, those will automatically be HSA eligible. And I'm certain you're going to ask me, what does HSA mean? Well, HSA stands for a health savings account, and it's a personal tax advantaged account that allows you to save and pay for qualified medical expenses tax-free now or into the future. Depends on when you want to use it. Again, tax-free. HSAs have a triple tax advantage. They're tax-free going in, so any contribution you make to them is pre-tax or tax deductible. Any money you put into them, it's going to lower your adjusted gross income when you go file your income taxes. You're going to the tax when you put it in, it begins to grow. That's actually the growth on that money is tax-free as well. And when you take it out to use it for qualified medical expenses, tax-free again. Additional benefits, the funds roll over year to year. So if you don't use it, it just rolls over and continues to do so forever. The account is owned by you, only you, not the bank, not your employer, not the health plan, you. It's portable. If you choose to move it to a different investment, you can do that as long as it maintains HSA. After age 65, you can use it to fund non-medical expenses. It's still, at this point, it is taxed like an IRA would be, but in my opinion, use it for your Part B premiums. You can do that, and that's a qualified medical expense. The qualified medical expense categories, items are exceedingly large You would be hard pressed to find some medical expense that is not on that list. The IRS publishes that. If anybody needs it, reach out and I'm happy to provide it. Excuse me, I need a quick sip of water. So what is the difference between what most people are used to and hear a lot of, which is the FSA, that's your flexible spending account. And that's not what we're talking about here. We're talking about an HSA. FSA is what your employer sets up. They own it. They give a certain amount of money. You use it or you lose it. It's done at the end of the year. Sometimes there's a slight rollover. It depends on the employer, but there are no investment options. Use it, lose it 1 year at a time. HSA, individually owned by you, rolls over forever and can grow through investments. Key takeaway, HSAs are the only savings tool that's tax-free going in, tax-free while growing, and tax-free when used for healthcare, making it one of the most powerful ways to save for both your current medical expenses and any sort of, I don't know, maybe future retirement healthcare needs. It's a fantastic way to do it. So in 2026, our contributions, because of course we have limitations on everything, the maximum contribution for the individual is $4,400. The family contribution is $8,750. Now there is a 55 plus catch-up contribution. If you happen to be 55 or older, let me know. I'll get into the nitty-gritty of that because it can get a little bit complicated. Then we have, and this is the most important thing, why are these HSAs important? Because we're trying to lower our adjusted gross income. The reason we're trying to lower our adjusted gross income is for those that fall above 400% of the federal poverty level. In 2026, if you fall $1 over the 400 percentile, you will have to pay the entire fair market price of your marketplace plan. And if anybody's ever looked at those without having a tax credit or subsidy, they're anything but affordable. So looking at this chart, and obviously your household size can be more than 5, but for purposes of this deck, I put 1 to 5 people. For this comparison for tax benefits, I'm going to compare, or Jordan's going to help us compare, household size 1 and a family of 4. Household size of 1, you're allowed to make $62,600. If you go $1 over, 1 penny over that, you will end up having to pay full price for marketplace. If you stay under that amount, you will get a tax credit or subsidy towards your premium. If you're a family of 4 and you make over $128,600, you're gonna pay full price. Get it under that amount. The lower you can bring your income, the higher your subsidy is going to be. The higher your subsidy, the lower cost for your premium. These are great things. And this is why I want you to use an HSA. This is why when that's not adequate enough, I want Pat to talk to you about other investment vehicles that can help. And Jordan, I'm going to have you explain a little bit about how this works in the practical world.
All right, perfect. Thank you so much. Okay, so we are going to look at 2 examples. Like was mentioned, we're going to look at a family of 4 and as well as a single household. So keep in mind that these households are the taxable households. These are all the people that are on your tax returns, people you are claiming as dependents, married filing joint with dependents, and so on and so forth. So for this first practical example, we want to take a look at a single person who is going to have a self-only health savings account. Their maximum they can contribute is the $4,400. If they are in the 22% tax bracket, which is this middle silver graph right here, this shows that your taxable liability, the amount of money that is actually owed to the IRS, if you contribute $4,400 towards that health savings account, there's roughly $1,000 less in taxes that you pay to the IRS, which puts more money in your pocket. In this case too, It also can be $1,000 that is going to be lower on your taxes, but it is also going to be something that could put you below that 400% federal poverty level, which, like we were saying, is going to have the premium tax credits as well. The next example is going to be that family of four that we were mentioning as well. And remember too, that cap is going to be the 128,600. So $1 over, you're no longer eligible. So in this practical example, again, we're going to look at the 22% tax bracket. It's that middle column in the silver. If this family contributes the entire 8,750 towards a health savings account, that tax advantage savings account, then the tax liability that is owed to the IRS is going to be lowered nearly $2,000 just for that family for that 1 year. That money again does roll over. It is still tax advantage. It is not use it or lose it. And then you're also looking at being able to have more of that premium tax credit. Looking a little bit further, so we're going to jump back to that self-only. This is the single person, the one-person household. You're not claiming any dependents. It is you, yourself, and you. And this is the poverty level, which is 62,600. In this case, this person is making 64,000. So it is definitely over, but not by much. It still is that cliff where 100% of that health insurance premium would need to be paid back. In order to make sure that you don't hit that cliff and pay it back, this HSA contributing $4,400 into that HSA lowers it to that middle bar graph, that silver bar of 59,600. Not only are you below that 400% poverty level, but you also have that $1,000 that we just mentioned too, that is less owed to the IRS. There are additional vehicles, some retirement vehicles, for example, that would even unlock some more premium subsidies, and that will be discussed a little bit further on, but that's that far right graph. Now, when we're looking at the family of four again, so this could be a single mom with 3 kids, married filing joint with 2 dependents, but it is your taxable family of 4. If this household pulls in a total of $135,000, it is above that poverty level, the 128,600. So in order to get past that cliff and get under that 400,000, we mentioned that they were going to contribute that 8,750 towards that health savings account. Now we're at that silver bar graph again. We're below that line, and we are saving for the premium tax credit. We're saving the IRS tax obligation as well. The far right graph also is another example of the household can take some more deductions and do some more tax advantage investment vehicles and lower their tax liability and their adjusted gross income even more. So we'll discuss that a little bit later on as well. One more click. So this is going to be the individual tax savings and the subsidy levels. So we've talked a lot about how much is going to be saved from the tax obligation, but we haven't really looked at necessarily how much is that subsidy going to be. So for example, if you are single and you're contributing $4,400 into that health savings account, you've taken $4,400 out of your own pocket. Now the big question is, well, can I afford it? Is it worth it? It's definitely worth it when you're looking at, you're going to spend $1,000 less on taxes owed to the IRS, keeping that in your pocket, and you're going to have the subsidy of approximately $3,500. So not only are we looking at almost $3,500 that you are going to have based on you contributing $4,400 into that health savings account. So the biggest question is, would you rather have the money in your pocket, or would you rather have the government have the money in their pocket as well for the taxes? And keep in mind as well, all of your contributions for the health savings account, it is not a use it or lose it. It is a continued growth, and you also get to keep that money. So it is still yours and you own it. Looking at that family of 4, here's the dollar for dollar example as well. So that family of 4 has contributed 8,750 collectively over the year. It doesn't have to be that one lump sum. You can do the monthly contributions that was mentioned before. That lowers your taxable liability, the amount owed to the IRS, nearly $2,000. And you are looking at a potential subsidy level about $7,000. So if you contribute 8,750, you are essentially allocated nearly $9,000. So again, you're keeping that money, you're paying less in taxes, you're paying less on your health insurance, and you're growing your investment over time. So when people consider, is it worth it? These are those dollar for dollar considerations that you want to make the base decision on.
Thank you, Jordan. And
Absolutely.
is it worth it? Absolutely. Absolutely. I have one. I've never had a problem. Easy to open up the HSA account, easy to contribute to it. I can do it monthly, or in my case, I actually wait until my taxes, I get the taxes in, or understand how much I'm self-employed, so I come up with my expenses. I see what my AGI is going to be, and then I go, I know what I have to contribute. So that's how I handle it. But most people can just, contribute 100, 200 bucks a month, whatever you're comfortable with. It's an automatic withdrawal from your checking account with most of these. Super easy to use, and they come in really handy, particularly when you need to use it for the qualified health expenses. And again, that list is ginormous. Please take a look at it. Contact me. I'm happy to provide it to you. Okay, so when you decide not to deal with the ACA, when you decide not to stay under or get a health insurance, period, this is just an idea of what you guys are going to be looking at. It's not a good place to be. You're looking at medical debt, most of you. Because I don't know about you, but if I spent 3 days in the hospital, I don't have $30,000 cash to be throwing at that. These are your average medium prices throughout the United States that I'm showing you. It could cost you more. It could cost you a little bit less, but that's pretty spot on for 3 days in the hospital. You break a leg, you break an arm, you're looking at $7,500. Those with kids, we know how typical that is. And then if you decide to have a baby, average for a no complications childbirth is 18,000 now. Things to consider. And why put yourself in that situation? Why expose yourself to medical debt that you'll be paying potentially for the rest of your life? And with that said, I want to talk about the alternatives. There are alternatives to the Affordable Care Act / Marketplace / Obamacare, whatever you want to call it. You have short-term medical policies and you have fixed indemnity policies. Your short-term medical is going to offer you the highest coverage. Fixed indemnity, it is exactly what it is. It indemnifies you a fixed amount per service. So those don't offer you near the coverage as a short-term medical, but a short-term medical isn't going to offer you the same coverage as a marketplace plan. They do require you to be healthy. So you have medical underwriting questions you have to answer in order to be accepted or denied coverage. And let's see, there are exclusions to these. Like I mentioned with the fixed indemnity, they're only going to pay a fixed amount. Anything you spend over and above that, or that you're charged, you will have to cover. Short-term medical, they can limit, for example, maternity prescriptions. They won't cover things like that. Pre-existing, of course, none of these cover pre-existing. But the cons, the pros, the cons, you're not going to get a subsidy. These aren't meant really for people that get any sort of subsidy, premium tax credit. These are for people that will fall above the 400 percentile or below the 100 percentile. So the pros on this, you got lower premiums by far, and you can enroll in these any day of the year as long as you're healthy. The direct primary care and the wrap options, direct primary care, great complement to anything, whether it is the ACA, marketplace, short-term medical, or fixed indemnity. They're just nice to have. You can call your doctor, you pay a monthly subscription, typically on an annual basis, and you have access to a doctor, kind of like a concierge arrangement. And then you have your wrap options. These I'm such a believer in. This is your hospital indemnity, your accident plan, your critical illness. These fill in the gaps. They help you cover your deductible. They help you cover your maximum out of pocket. Critical illness is your cancer, your heart attack, your stroke. You're going to meet your max out of pocket if you get any three of those. Accidents. Why have to pay your ER bill when you have an accident plan? You had an accident, it's going to reimburse you whatever that cost was. Your hospital indemnity, sickness, injury, you end up in the hospital. You get to choose the amount of coverage you want, and it's a monthly premium, and it's a whole lot less than having to meet that maximum out of pocket or pay that deductible. So I hope many of you will consider. If you need any information on those, happy to send you some brochures. But in the meantime, I want Pat to tell you more about what happens if you are above the 400%. You've already contributed to the HSA account, your max, but you're still above the 400 percentile and you need the marketplace plan because your health isn't good. Pat, what else can they do?
Thanks, Jill. I want to take a minute to talk about retirement plans and how they can utilize those. And I'll start with a 10,000-foot view and talk about the two main types of retirement accounts without getting into 403Bs, 401Ks, simple SEPs, all that stuff. So really think about it. You have what's called a Roth option, which is an after-tax option. Great if you want to pay taxes on today's dollar and not tomorrow's, but really won't help you with your adjusted gross income. So if you want to get below those 400% poverty levels, you really want to take advantage of your traditional or qualified plans or pre-tax, which we'll call from here on out. So this slide here shows you the 2025 limits was for a 401k, 403b, or basically an employer-sponsored plan, 23,500, and then if you're over 50, you get a catch-up of another 7,500. In 2026, they are going to go up for the first time in a couple of years, so it's going to be 24,500 in 2026 if you're under 50, an $8,000 catch-up. So that gives you a total of 32,500. That's your contribution, not including the match from the employer. And then if you're between 60 and 63, you can actually max out at $36,000 in contributions. We'll cover an example later why that'll be important. The next slide I want to show you is an individual IRA. Now, again, we talked about the 401ks and those plans, and actually you have to be at least one employee. That could be just the owner, and those can be set up that way. But if you want to use an IRA and separate from what you're doing at your employer, that's certainly an option. Again, we're going to do pre-tax dollars. The limits for 2025, as you probably know, are 7,000 for under 50, an extra 1,000 or a total of 8,000 if you're over 50. Those are going up for 2026. 7,500 is the limit if you're under 50, and then an extra under $1,100 catch up for over 50 for a total of 8,600 on the max contributions. Let me cover a sample of how you can lower your income. The samples we're going to use today are Sally. Sally is a single mom with two kids, two dependent children. That's the important thing to keep in mind. So her limit, as far as what she's able to do to get a subsidy or to help her lower her premiums, is 106,600, as you saw on the slide at the beginning of the program. Now, this is Sally making 60,000. She's far below that and will get a subsidy. But if she participates with $3,000 or 5% of her income she contributes, that's certainly going to afford her a better subsidy or lower premiums. So again, just because you're under that poverty limit, or if you're a little above to get a little below, that's important, but also utilize them so you can lower your premiums if you're already below that amount. Now I want you to visualize this. Let's say she made 110,000. That's $3,400 above the limit. Again, like Jill said, one penny, or in this case, a whole lot of pennies over, $3,400 worth. She would not get a subsidy at all. She would have to pay the full premium. But if she were contributing that same 5%, that would be $5,500 to take her to $104,500 of adjusted gross income. Now eligible for a subsidy and not having to pay the full amount. Just trying to keep it simple. If you have questions, Jill will direct you on how to reach out to me to talk about that. But again, we're just here to help. I'm going to pass it over to Jill so she can talk about, as soon as I can find how to stop sharing, so she can talk about how we're going to summarize and help you guys out.
Thank you, Pat. I hope you all can see my screen. Great, thank you. So basically, it's going to boil down to this. And Pat was 100% right. You know, I've been using these strategies for years, not only the HSA, but also investing in my individual 401k, because I am the owner and the employee. They come in really handy to keep my premium with the marketplace very, very, very affordable. We shall see how much more I need to contribute next year to do the same. So using the federal poverty level, as you saw, you've got to watch where you fall. If you're one person, you saw the amounts from 1 through 5. If you happen to have more than 5 in your household that are your taxable household, let me know. I'm happy to send you this chart. If you just need to see it again, happy to send it to you. Use that and work with your adjusted gross income. See what you need to do. Do we need to contribute to the HSA? Do we need to put more money into some sort of retirement plan? Whatever the case may be, it's going to benefit you, lowering your monthly premium, lowering your taxes that you owe Uncle Sam, and helping you save for the future or medical cost immediately or in the future. It's a win-win-win all the way around. So maximizing these tax advantaged accounts, just like I just said, you know, use these to lower your AGI. They will help you in every facet imaginable. It takes a little bit of effort on the front end, but once it's done, it's like clockwork every year. You just contribute. Then you compare, and please folks, don't look at the lowest cost plan. I know so many people come to me after they've chose their plan, after it's come into effect, and when I can't do anything to help them because they saw a $0 premium or $10 premium, and that was the worst plan for them possible given their situation. Talk to a professional. If you want to see how to maximize into a retirement account, talk to Pat. I'm happy to hand you his number. If you can't figure out your AGI and how it's going to affect you with your federal poverty level being 400% or over, or even like Pat was saying, bringing down your premium because you want to bring yourself, you want to get your AGI even lower, talk to Jordan. In fact, let me go ahead and provide you Jordan and mine information so you have it. You can jot it down. And for Pat, just reach out to me. I'm happy to provide his phone number and email or a Calendly link. Do you have Calendly, Pat?
Yes, I do.
Awesome. So yes, we can all provide you a Calendly link. I have Jordan's. So anybody that wants to reach out to me directly, I can hook you up with either 2 of those. And I thank you so much. And by the way, these consultations are no cost to you. So reach out, get the information you need. We're very kind people and we just want to help. Thank you all so much. Have a great rest of your day.